Apple stock received a downgrade from Wall Street analyst Laura Martin as the analyst sees sluggish demand for the company's latest generation iPhone. I'm going to talk about the details of that recommendation downgrade from the Wall Street analyst and also give you my recommendation for Apple, share with you my proprietary discounted cash flow valuation for Apple, and look at Apple on a forward price to earnings basis and share with you my updated recommendation on whether or not I think the stock is a buy, hold, or sell.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Apple stock is no longer a recommended buy according to the analyst at Needham. The iPhone maker's valuation is too pricey compared with its big tech peers and doesn't appear primed for a strong device update cycle. The analyst Laura Martin downgraded Apple to a hold from buy and withdrew its price target of $225, saying, "We move to the sidelines for Apple owing to its expensive relative valuation, increasing fundamental growth headwinds, and rising competitive threats," the analyst said in the research report. And that's pretty much what I've said about Apple coming into 2025. I did not rate Apple stock as a buy coming into 2025. I rated the stock as a hold. And one of the reasons why I rated the stock as a hold was because of valuation. So according to my proprietary discounted cash flow valuation model for Apple, the intrinsic value per share I calculated is $173. The current market price is $203. So even accounting for a margin of safety, Apple stock looks overvalued on my calculations. Now I've even given them a long-term growth outlook of 5%, which is above the usual 3% I apply to companies. Given that Apple is an international business, many of the markets Apple operates inside will grow at a faster rate of increase compared to the United States. And then nominally speaking, the company's revenue should be correlated to inflation. So if inflation increases, it should provide a higher average selling price for Apple's products and services. And so I've given them a longer term 5% long-term growth target. And the weighted average cost of capital I'm applying is 10.86%, cost of equity of 11.72%. Now I'm forecasting Apple's free cash flow rises from $123 billion in 2025 all the way up to $264 billion by 2035. So I am also forecasting significant growth in Apple's free cash flow over the next 10 years. Still, despite those robust forecasts, Apple stock looks overvalued at the current market price of $203. This is, of course, even on top of the fact that Apple is very, very at risk of the increase in tariffs. The President Donald Trump in the United States has increased tariffs on all the United States trading partners, most notably China, which Apple relies on significantly for manufacturing of its products. Apple, to adjust to those rising tariffs, has moved production to India as much as it can and has signaled it will increase its capacity, its manufacturing capacity in India. President Donald Trump, after hearing of Apple's plans to move production from China to India, was not happy about that and said, "I don't think Apple should be producing iPhones and other products in India. They should be producing products in the United States." So it's uncertain if Apple's strategy of moving production from China to India will help alleviate those higher tariffs, those higher cost of goods. Apple may ultimately face higher cost of goods to produce all of its products. And the good news is that Apple generates very strong profit margins on its products, and the services, of course, generate even better margins. And so it might be able to mitigate some of those things. But this is just an added risk on top of the headwinds the company is facing in terms of slowing growth, slowing sales of its iPhone. Now, when measuring the company on a forward price to earnings basis, it's trading at a forward PE of 28. which is about where the company has traded for going back all the way to January of 2022. It's been lower at times, it's been higher at times, and at 28, it's right about the middle of the road, which I think is too much given the current headwinds the company faces and the increase in tariff risks. I think this stock should be trading closer to the lower end of its forward PE valuation, closer to 20 or 22 rather than 28. So even on a forward PE basis, Apple stock looks overvalued. By the way, I'm getting all of my data from finchat.io right now, and the company has offered a 15% discount to any of my viewers using the link in my description. So I can understand the analyst, the Wall Street analyst that's downgrading Apple stock from a buy to a hold. I actually downgraded Apple stock from a buy to a hold several months ago to start 2025. I was already pessimistic on Apple given these headwinds, even before the tariff risks, given its slowdown in revenue growth and the increase in valuation. And then we got all the increase in tariff risks, which made me even more pessimistic on Apple stock. So I had the stock rated as a hold to start 2025. I've had the stock rated as a hold all year long in 2025. I've not upgraded it to a buy at any point in 2025. And after seeing this analyst and the report this analyst generated for Apple, I just have to say that it's similar to what I've been saying about Apple all year long. And I happen to agree with this analyst in downgrading Apple stock to a hold. And I updated that recommendation here today again on June 4th, 2025. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.